Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of your hosts for today, and we've got a packed agenda. There's a lot going on. So we're going to kick it off with some discussion about the new administration and status of some important legislation and business relief and tax extensions. And then we're going to get into the IFR that got released last night. We're going to give you our interpretation of that. We're going to talk about how the lenders are managing that. And then we're going to close with a discussion around ERC and then the open forum. So once again, you can earn CPE by responding to 75% of the pop-ups. And please do refresh your browser if your video freezes. And on the bottom toolbar, you can download the materials for today's event. And there's a lot of materials there. So once again, I'm Eric Auskerson, one of the AICPA executives, and I lead the business and technology subsidiary CPA.com. With us today is Kristen Esposito, one of the leaders of tax policy and advocacy at the AICPA. You all know Barry Melanson, the president and CEO of the AICPA and Association. Mark Peterson leads the advocacy area, and you all know Lisa Simpson very, very well. She leads the firm services area at the AICPA. So I want to bring Barry up now to just kick this off. And Barry and I are just going to talk broadly about what's going on with the firms and the broader ecosystem. And once again, what these town halls are all about is us bringing you the latest information. And that's what we've done this week. It's a very intense week. A lot of discussions going on with the governmental officials, with the firms, with the lenders, and a lot of work in interpreting all that is happening. So Barry, you've been talking to so many firms, and you know the pressures. In some ways, it feels like the pressures have never been greater related to the trusted advisor role. We've been talking about this for the past year. There's great opportunities in what role the firms are playing for their clients. With that said, it's been some tough sledding. The past couple of months. So why don't you share some of your perspective on this?
Maybe the word is anxiety, Eric. First off, it's great to be with you. But if we take the word anxiety, there's just tremendous pockets and inflection points of an anxiety in the system right now. We got tax season going on. We're going to talk about tax due date in a little bit. We've got a whole bunch of things unfolding in the PPP area, including potentially new funding, but new rules as it relates to some of the aspects, including Schedule C, which are very complicated, and maybe some unfairness issues associated with it. We're going to talk about that a little while. But what I think we're experiencing is, as a profession, we really are in the eye of the storm, and it's sort of hard to believe a year after the start of COVID, we could be in such of an intense environment. And because of all the moving parts, maybe now more than any other time, it really calls upon our members in the CPA profession to be the stabilizing force. There's a lot of things from government, from banks, from all sorts of different places that can go wrong, Eric, or might be out of sync. And it's just really important to be the thinker in the environment with your clients and otherwise, to say, this is all going to work out. There's a lot of uncertainty. And with anxiety, people like to push the panic button, and panic buttons aren't going to help right now. And I think that is just really the important part of where we are.
Yeah, Barry, it's well said. And it peaks at times. All of a sudden, like right now, and it peaks for different areas. We've got the IFR from last night, and there's a lot of frustration with a lot of the Schedule C applicants that have already applied and been funded. So what we need, we're working at this. We're going to work through it. And you're right. So where is this going to go? And we need it's hard, but to have patience. But you need to have a little bit of patience. And in the lenders right now, we just got off a big call with the lenders. Exactly. The lenders are trying to understand what to do. So escalating right into a lender, or even escalating into the SBA. These are things that we need to work through. So that we're going to do that over the next 55 minutes here. But maybe one last comment before we bring Mark up.
You're going to talk about the lenders and et cetera. I just think you're going to see people in the system right now. And we might be adding to it because we're going to talk about tax due date in a minute. But you're going to hear people almost throwing their hands up with frustration. And not that it's bad people, not it's people that aren't, trying to do the right thing, but it's just so many moving parts right now, and you're going to hear them. And I think that it's just, if you don't take anything else out of this town hall, I think, is that I really think it's important as you deal with your clients, as you deal with people whose business survivability is on the table, wanting the money, frustration, is to be that voice of reason. And when we talk about trusted advisor, being the voice of reason is part of being about that trusted advisor as well. And there's a degree of calmness, I think, that the profession can bring to this process that isn't because of the profession we need to have that calmness, but we can help bring calmness that's coming from other parts of the environment. And what a wonderful, wonderful value proposition we can bring if we in fact do that.
Okay, thanks, Barry. So Mark Peterson, join us. I mean, it's I think we're about 50 days into the Biden administration, a lot going on. You've got the Stimulus Act, tax deadlines, ERC. So share.
No, absolutely. And it's interesting because the transition that's going on into a new administration is actually on par with past administrations as far as timing. It's just the intensity because we're in the middle of the stimulus stuff that's going on and a lot of other pressure that we're looking for answers. These policies started, in the last administration. They're bridging into the new one, which creates, I think, a whole nother level of anxiety, which seems to be the word of the day. But if you go to the next slide, Eric, we've got Department of Treasury is manned. Guzman is going to be at the SBA shortly. There are hearings that are going on probably before she even gets there that are going to be very focused on PPP and some of the changes that are going on with the PPP program that we're going to be talking about, which have created hurdles. The only reason her floor vote has been delayed is because they've got to get the stimulus package out of the Senate. We're going to talk about the timing of that. But all anticipation is she's going to be there, and that will help. That will provide the leadership at the agency to move forward with these things. Off of PPP and small business, for the profession, Department of Labor is another one that we watch related to employee benefits. And again, that's all headed in a direction of getting Secretary of Labor there. And then on the public company side at the SEC, Gary Gensler has had his hearing and it will be going to the committee. And we're anticipating again that's going to be on and off the Senate floor as soon as they get the scheduling taken care of with these other priorities that they have.
Hey, Mark, one thing that, as we're talking to a lot of the officials that are being put in below Yellen and Guzman and we're talking about just getting out there and communicating, because one of the things that we need to do is communicate more on what's happening, communicate the fact that there's all these error codes, or communicate what's going on with these latest changes. So I think hopefully it couldn't happen soon enough to get more active communication occurring from some of these leaders.
No, it's true. And again, these circumstances are extremely challenging because you had a program that started in the last administration and it's been moved into this administration. So I'm from Minnesota. I played hockey and we've had a line change. Right. So you've got a whole new group of people that is trying to implement it, trying to get to the answers, but they've got to figure it all out too. And that has just created some challenges. We're seeing that. Right. Again, we think we'll get there, but there are challenges. So, okay, the STIM bill, let me just tee this up because, again, it's going to have an impact on a couple things that we're talking about today, and there's a big timing issue. So $1.9 trillion, close to $2 trillion, another major package that's going to go out, made it out of the House, party line vote because they use reconciliation, which is the process at which you don't need a supermajority in the Senate, all expected. We've seen this regardless of who's in charge of the House and the Senate. It showed up yesterday in the Senate. Senate was supposed to have started to take it up, but there were some challenges because of processes. They have to get scoring from the Congressional Budget Office. That's in. There is a disagreement over the policy because it's being run again with the focus on being a 51 vote majority versus a bipartisan package. And so because of that, they're going to ask that 600 pages of the bill are read, which could cost 10 hours. And then it goes to 20 hours of debate. And then there will be a series of amendments that will be voted on, which will just take time. But in the end, we absolutely anticipate that it's going to pass. The Senate's going to change the House package. They're going to strike an increase in the minimum wage because their rules don't allow it. They're going to make some other changes related to the stimulus checks, who gets them at what, your income threshold, and some other changes too that we're seeing. That will mean that, maybe Saturday, maybe Monday, that the Senate's going to send it over to the House. Now, usually what happens is they conference it and then they negotiate that out, and then they come to a package between the House and the Senate. They're not going to do that because it takes too long. So that means that it's really a game of chicken, and their Senate is saying to the House, accept our changes. So, in all likelihood, because of the importance of this package, the House will accept them, but they're not going to say it until the Senate has passed this and they can see what they're voting on. The big thing here is to try and get it done before March 14th, because that's when unemployment insurance runs out, the supplement to it. So the goal is to get that done so that the states can start to react to it to make sure that there isn't, some interruption in the checks that go out. Within the package, some big things, $50 billion to small business, which is another, chunk of money that's going to go into the PPP program. There is at least $7 billion that's going into that, more $15 billion into EIDL, some grants that are going to go specifically $25 billion just to restaurants. So as this plays out, there's going to be a lot more money that flushes through the system. And again, this is legislation in process. And so literally, as I was sitting here, we just got some amendments that are going to be offered, and they're actually talking about expanding the employee retention credit. So we haven't seen the language yet, but we've seen a discussion document that talks about they're going to potentially expand that. We'll see where that goes. Another big one that leads us into our next discussion is the direct payments, the $1,400 checks that are going to be going out to individuals. They're discussing that about targeting it, which means that the House is going to have to potentially react to that. But in all likelihood, they're going to be going out. Next slide. So that takes us to our tax due date issue, which Barry teed up. And one of the things that we saw from Commissioner Rettig at the IRS, as he's talked about, how you're going to deal with tax April 15th under a COVID environment, just like we did last time, is he said we're going to stick with it, April 15th. However, he has cracked the door to delay if, in fact, these stimulus checks go out. And again, in all likelihood, they're gonna. So I think that's a very relevant point about the likelihood of where we're headed. Next slide. And then, Barry, you should comment about this because it's complex.
Yeah, it's very complex, Mark. And there's a lot of important parts in that bill, and the direct payment has a direct impact on, frankly, the tax due date issue because of IRS service. And these town halls, we've been talking about the IRS service issue. We previously issued a letter. It was sort of a if-then type letter on the tax due date saying if these things happen, if the IRS service can't be addressed, we need definitiveness. We need a quick answer to this. It can't be strung out into the beginning of April. There needs to be time in the system for state tax due dates to be addressed. And obviously, if there were direct payments, then the IRS is going to be consumed in that process as well. And we know, and many of you here are going to be on different sides of this issue. There are a lot of people in our profession will say, and not just in our profession, but all preparer communities, some in favor of moving the due date, some opposed to moving the due date. By the way, you have a lot of unemployment that was paid in 2020 that might have been under withheld that's going to have people who might not be used to having taxes due on April 15th have a tax due situation. So there's a lot of complexity in the system. So we had issued a letter saying, if these things look like they're happening, you really need to address sooner rather than later moving the date. We just issued a letter today saying you need to move the date. And again, I acknowledge some of you will not, like that, but we have said you need to move the date to June 15th. There are a lot of reasons why June 15th is better. You need to move it for all tax items due and payments. June 15th is the first estimated tax payment, so it eliminates one of the calculations in the process. It's hopeful that we can get state alignment, but June 15th as well. That'll be on a state-by-state issue. But the biggest issue is that, again, good men and women at the IRS trying to do the right thing, but there's just a capacity issue from being able to make our voluntary tax system work. And obviously, there's a lot of pressures inside firms, and some people want, let's get it over with because then people can catch their breath. But the uncertainty is a huge issue as well. And so we have today officially called for this date needs to be moved because as Mark said, there's nothing 100%, but it's pretty close to 100% that this $1,400 payment is going to go about, and it's going to be handled by the IRS, and it's going to continue to bog down the system. And oh, by the way, there's a certainty. There's a lot of backlog related to even 2019 items that have not been addressed by the IRS. It's not because they don't want to, but they haven't been able to. And that just adds more complexity that practitioners and taxpayers have in this environment. So it's part of this sort of stress point in the system. We live in very unusual times, but it is important, we think, now to make this sooner rather than later, as quickly as possible, make this decision and move it.
Absolutely. Thanks, Barry.
Yeah, thanks. And this brings us to another kind of date matter. First, we're just highlighting here this article that was in Political. Biden faces backlash over small business rescue overhaul. So last week, Biden announced some changes to the PPP program. It was actually Biden really played an active role in this speech last Monday. And then last night, the IFR was released, and Lisa's going to be reviewing the details in a minute. But what the AICPA released a statement stating that this March 31st deadline needed to be extended. And I'm going to give Barry a chance to comment, but there's really two drivers of this. One is that there's all these error codes, and the resolution process to get them done is complex. There's actually applications that have not been able to be successfully submitted into the SBA systems yet. So these need to be fixed. Then secondly, the whole purpose of Biden's announcement was to expand to more of the underserved and minority communities, and really target the Schedule C filers. And now we're going to be issuing this new information next week related to how the banks will be turning up their platforms, hopefully next week, to support these new processes. And these smaller businesses just need more than 2 weeks to get it done.
Eric, I think this is, again, a very complicated issue. So we were on record even before this last IFR, everything else, that it needs to be moved. First off, the president wanted to carve out a period of time focused on small businesses. That's a good thing. And we said that was a good thing. Yeah. But now in the middle of that, you have sort of a pause that is happening because of the guidance. There's a lot of confusion on, when the change is made to being able to calculate it on the basis of gross versus net on a Schedule C. There's going to be there is already political pressure growing because of the SBA's position that if you've already filed on the basis of net or been funded on the basis of net, that you can't go back and change it. That's an inequity point that's going to be very loud on Capitol Hill. And plus, as Mark Peterson just said, there's more funding for PPP. That's not even going to get passed and signed until next week, and then it's expiring at the end of the month. And so we have to extend the program. And the other thing that I would say on this, Eric, and it'll tie into some of the work that Lisa is doing, and I know you and I have talked about this a lot, but for all of the firms here involved in PPP, this is going to get sorted out. The banks are going to have a frustrating week, and there's going to be people who are frustrated dealing with the banks in the next week. But it almost calls for practitioners to go into their files and look at every Schedule C that's been filed with their clients, because it's a huge opportunity here. The rules have changed. The use of gross is there for you. And this is a great opportunity as well to get to the objective, really, that I think the president was focused on, the underserved community. Tremendous amounts of people who have businesses, they're Schedule C filers, no employees, they've been impacted by this. And, it really behooves someone in your firm to go back and look at every return and see whether there's a Schedule C and see if there's a PPP that should be filed because of that. And I really would encourage that. And then I think opportunities to work in your community. If you're in a small town, work with the underserved community. There is a focus here. I'm pretty sure the deadline of March 31 is going to get extended, and they're going to get some sorting out of these conflicting ideas of the Schedule C. And when we give it time to breathe, there's a lot of opportunity there for the underserved community.
Well, we got a lot to cover here. So, Mark, we're gonna pick up the pace here a little bit. We'll be bringing you back for the open forum. We're going to talk some about the SBA lender processing before we get into the IFR review. So, let's just jump right into this. When you look at where are things related to the PPP program right now, we've got 2.2 million loans basically approved for 156 billion. And what that means is there is actually still a lot of funding left. I think many of you know, we've got the CPA loan portal, and we partnered with Biz2Credit. It's been a very active program. They are actually a number one in loans approved. And one thing that we're going to start talking about is loans funded, because that's what matters. You get a loan approved, you get an E-Tran, but what's funded? By the end of this week, they're going to be close to or over 100,000 loans funded, and probably the loan amount is going to be one of the highest. And what we've been doing with them is really learning about the entire process as we support over 1,000 firms who are leveraging that platform. And when you look here, this kind of highlights how it's been going out. It's quite different than back in April of 2020, because in April of 2020 it went out fast, but with all the validation checks that the SBA has in place now, it actually is going out in a more measured way, as you can see here. And this brings us back to the important points that Barry was just raising related to Schedule C. So I'm going to get into that in a moment, but let's just take a quick look at what needs to happen now with this new IFR. And Lisa's going to talk about the Schedule C changes, but those applications need to be updated in the lender platforms. They actually have to update the forms for the 2483, the 83SD, and this new Schedule C. There's new government required declarations. There's been changes there. It's significant. We were on a call with lenders today. Some of them, they're floored by the amount of changes that are going to have to be made. So this is going to take some time. With our CPA loan portal, we're looking to be back up with all this updated early next week, Monday or Tuesday. And then there's these other questions that need to be addressed. One point that the SBA even made is if borrowers have not been approved an E-Tran loan, they could withdraw it. And you need to think about that. Right now, if you withdraw it with this March 31st deadline, it takes 1 to 2 weeks to withdraw something successfully from the SBA systems. So you're almost in this catch-21 phase. We know right now that firms are actually reaching out, Mark, to their elected officials related to some of that. Just to kind of highlight the need to kind of get that March 31st deadline extended. And then this is the point that Barry just raised. Barry got dropped here, James. I don't know if you want to bring Barry back up. And but this here, if you look at the number of sole proprietors in the U.S., there's 25 million. It's roughly 25 million, and roughly all of them are doing Schedule C filings. This is the number since the start of the PPP program back in April of 2020. 2.6 million sole proprietor independent contractors and self-employed have already been approved for PPP loans. So there is a big group. There is a big group of Schedule C sole proprietors that are eligible. Yes, some of them are hobbyists, Barry, but this is something that we know the Biden administration wants the firms and the lenders to really go out and work. And Biden mentioned this in his talk with others to get connected to these people that are eligible and that need the relief.
Right. It's really a targeted activity. It goes along with the point I was making. I think in existing clientele, everybody that's got a Schedule C should be reviewed. And then there's opportunities in the marketplace that you might be for others. And Eric, you talked about the portal and the work with Vista Credit. You know, a lot of smaller, which would be Schedule C type loans, are being funded. They're going to rush to make the modifications related to these latest set of changes that are going forward. I really think it's a great opportunity for people. I know there are many in our profession who, you know, want to see where their services can be brought into the underserved parts of the economy. Sole proprietors are, as you said, is at least 20 million probably sole proprietors out there that probably have eligibility to PPP that are still out there, and it's and many of them are hurting, and so it is part of what the government program is actually targeted to.
And just one thing, just to we talked about this earlier. You know, what can you do right now? Right now, a lot of the lender platforms, what they're doing is they're not allowing submission of applications to the SBA because you have to update all these forms. You have to update the way the Schedule C calculation is done. So this is going to take a couple of days. So the thing to do now is to go out and identify additional borrowers who potentially could leverage this. And then starting next week is when you'll start being able to process those applications.
So you have to
go ahead, Barry.
So I was going to say, if you're dealing with your clients in it, you have to set the expectation of the time frame. That's a very important point.
It's a huge thing, and we're going to work harder on that, setting expectations. We really do got to get that deadline, March 31st deadline, pushed out. But this is just real quickly, we have other webinars that we're putting on twice a week where we go into these error codes and the platform in much greater detail. But this is a good visual. This shows you what's happening. You know, a lender tries to submit something into the SBA, it can get declined. It can get declined due to validation checks right there at the front door. Then the lender needs to resolve and resubmit it. Then if you get submitted, you're in the SBA system. You can go two areas. You can have a validation error that then needs to have further resolution with the lender, or you go into this SBA review process, and then you still there can have an error code flag. So there has been more and more understanding of this over the past 45 days. Barry, you mentioned, you know, the eye of the storm. We were in the eye of the storm on January 16th. Nobody knew about the 65 error codes, but now we do. And there's lots of techniques that are being put in place to understand how to do error code resolution, hold code resolution. What are the steps? What are the processes? How do you do it? We've been informed with the Vista Credit platform. We've done more error code resolution than any other lender. So we have some good understanding of how to do it. It's hard. And guess what? Client by client, there's a lot of frustration because you're frustrated when you're stuck in this error code resolution process. So Lisa, I know you've talked to a lot of firms about this. Is there anything that you want to add?
Yeah, we're seeing error codes and hold codes come about because of things like a DBA. A lot of businesses operate with a DBA, and that wasn't a problem in the first round, but through the validation checks and hold codes, that's catching them. Borrowers are having to produce invoices to show that they were actually in business on February 15. If their match within the error code system doesn't show that they were an active business at that time, it is a very manual, time-intensive process. So I'm hoping that by giving you guys these visuals, that helps you understand why your clients' applications might be getting stuck, and then you can help have those conversations with them about how to get resolution on them. But it's frustrating.
Yeah, and Lisa, you're right. There's false positives. There's databases that are doing false positives. Then there's databases that are flagging things. They're just trying to make sure that everything's accurate. You need to have been in business, so they just want some data. They're asking for more data this go around than they were previously. So here's forgiveness, another big topic. And guess what? There's not a lot of forgiveness activity occurring with lenders or with the SBA. It's even back to that IRS point. People are maxed out, so there hasn't been much that has been processed recently. But here's the number: 160 billion has been forgiven. So about a third. And one question that at least I know comes in every week is applications above 2 million. And then there was this 90-day period that the SBA said they would respond, and most are 100 days plus.
Yeah, and we're getting mixed signals right now. I've heard from some folks on our town hall today that talked about getting their 2 million and above loans through the process without even having to do a 3509 loan necessity questionnaire. We talked to some CPAs who got a couple of their clients 2 million and above applications released last week with total forgiveness. But then on our lender calls, they're not seeing much movement there. So it's a mixed bag right now, but if it's been over 90 days, don't panic that you're not alone. The SBA is certainly taking their time while they're working on some of the other issues within the processing.
So I think just in conclusion here, as we move into the IFR section, I don't know if you have one concluding remark, but if you think about what's happening, there's lots of changes. These are significant changes with this IFR that are going to require platform updates, and then you've got even this forgiveness element. When we talk broadly with some of the Treasury and SBA officials, they're saying they want to make great improvements. They want to make the forgiveness process really work in 2021. So I think hopefully that's coming, and hopefully if we can get an extension as March 31st deadline, we think we can actually set up processes that make it really efficient and effective to do Schedule C borrower applications, and that would be great. So I think let's be hopeful that we can make things better, and we're working hard at it. I can tell you that we've been going nonstop since early January, Barry. So we're going to, before we get into Lisa's section.
Let's go to the IFR. I think it's important to do that. But I think the key messages here is that it will happen. But again, patience in the system, because the SBA has turned off that volume on the forgiveness side right now.
And as a reminder, before we move to the next IFR, a quick reminder about forgiveness. When the Economic Aid Act came out, forgiveness was streamlined for loans at 150,000 and below. The lenders are just tomorrow or maybe tonight getting an updated interface with the SBA to allow them to process those forgiveness applications at 150,000 below with the new guidance. So that put a big halt to a lot of forgiveness activity, and we expect that we'll be seeing that pick up.
Okay, so Lisa, now you've got Lisa Barry will bring you back for open forum, and Lisa, you've got a great selection of slides here that I know are going to be well received.
There is a lot to cover, so I'll try not to talk too fast, but I just want to start by saying that some of these points I'm not going to cover in detail. They're in your slides so that if they apply to you, you'll have the information and you can go check out the details. I'll quickly remind you that we do have our summary document available. If we go to the next slide, you'll see that I've identified some of the topics in italics that I think we're going to need to update based on the IFR that came out last night. So we'll get started on that and get all of that new guidance worked into the document. On the next page, we've got our FAQs, and those will also be being updated quickly. So I want to make sure you've got the links to those so that you can go check to see that you've got the most current. As we get rolling into the details of it on the next slide. Okay, so here we are. We're actually at the IFR. So this one's called Revisions to Loan Amount Calculations and Eligibility. It basically does three core things. It allows individuals who file on a Schedule C to use a different formula that's going to be very similar to our Schedule F borrowers from the Economic Aid Act, to use them to calculate their loan amount differently. So we've talked about that, and we'll go into some details. It also removes eligibility restrictions that prevents business owners who have non-financial fraud, felony convictions in the last year to now be eligible. That was part of the White House announcement last week. This IFR puts that into place, along with easing the restriction for borrowers who are behind on their federal student loans. They're now more eligible to apply for PPP loans. Okay, really quickly, these changes do apply to both first draw and second draw loans. So now let's get into the details of that Schedule C calculation. So this is for sole props, independent contractors, self-employed individuals, and I've got a couple of caveats at the a little farther in about who else can use this methodology. It is for loans approved after the implementation date of the IFR, so it's not allowing for retroactive change right now. If a borrower has no employees, their maximum loan amount is based on either their 2019 or 2020 Schedule C, and they now have two options. They can use their net income or net profit from line 31, or they can use line 7, which is gross income. We've still got that caveat of not to exceed $100,000. Calculate the monthly average, figure out what 2.5 months of that is, and if it's a first draw, the owner's comp can go up to $20,833. If it's a second draw, it's $20,833 unless the borrower is in a NAICS code of 72, so that accommodation and food services, then they get 3.5 times, so that would get them up to $29,000. If you haven't filed your 2020 tax return yet, then you can use the information that you expect to file. But I would be really, really close on that. I wouldn't just be throwing numbers on the draft Schedule C. If you've got employees, the calculation is going to look a little more complex. But again, it looks a lot like our farmers who had employees. You're going to use two options. Again, it can either be your net profit from line 31 or your gross receipts, and then we're going to adjust it for your employee payroll costs. So you're just going to pull the lines from the Schedule C that relate to employee benefits, profit sharing, and other employee wages to come up with what the owner compensation is. Divide that by 12 to get your monthly average. Cannot exceed $100,000. Add in your average monthly payroll costs for the employees, so non-owner employees. Multiply that by 2.5, and that's how you'll get the loan amount for a Schedule C with employees. I know it sounds complicated, but when we look at the form, it'll make it a little simpler. So who can use this method? It is for Schedule C filers, but there are always questions about what if I'm a single member LLC, so I'm a disregarded entity. They are also eligible to use this methodology. And then there's a scenario where it's a qualified joint venture and you've got spouses operating the joint venture. There are some details in the instructions to the form. So if you've got one of those scenarios, please just make sure that you're digging into the instructions, because there are some different factors to consider there. I'm already getting questions about Schedule S Corp filers. So if you're a single member S Corp, and are you eligible to use this method? You are not. If you look at how to calculate loan amounts, S Corps are required to be based on wages. So they are not currently given this opportunity. Why is this change being made? So we talked earlier in the conversation about how a lot of Schedule C filers really don't show much bottom line on their returns. So when the decision was made to use that net profit, that net income line of line 31, that meant that borrowers weren't getting compensation to cover rent or utilities. They may have warehouse space or a small office that they're renting. Those costs were not baked into their calculation. So now that's this methodology is trying to adjust for that.
And Lisa, just what we talked about it already, but as you noted, March 3rd is it has to be for applications from March 3rd and going forward. And as we said, most of the banks, lenders won't be up till next week. So we'll start next week. And this is a big issue. Is what about those Schedule C applications that were filed in January and February and funded? And that's something that we're going to talk to SBA and Treasury and the policymakers about. And I think that's something that I already know some CPAs have told us that they've called their representatives saying this doesn't seem right. But what we just covered is what the current guidance is.
That's correct. Yeah. All right. So this is what the form actually looks like for a first draw application. And you'll see the tables right there in the middle. It's going to ask you for the amount of the gross income and what tax year you're using and the number of employees. If you don't have employees, if it's just you, then your number of employees is 1. And that's lined out in the instructions to the application. Then it walks you through the calculations. So again, as I said, it's kind of hard to say in words, but if you look at the formulas, it's not going to be that complicated. You have the opportunity, if you are a first draw borrower and you had an idle loan and you want to refinance that, you can. I've got hyperlinks at the top of each of these pages to the actual form, so you can go check those out and get the instructions. This is just what the second draw looks like, so you can see it's very similar. The main difference here is it is accounting for the NAICS Code 72 second draw borrower being able to get 3.5 times.
And you can't get 3.5 for the first draws. That's one thing that is an error or something that sometimes people confuse.
Yeah, exactly. Okay, so there's an important consideration if you have a Schedule C borrower who wants to choose to use this gross receipts methodology. If the loan is, or if the application is showing more than $150,000 in gross receipts on the Schedule C, the borrower is basically foregoing the economic necessity safe harbor. We've talked about that in the past. It's coming back up as an issue here. It doesn't mean that the borrower shouldn't use this methodology. It doesn't mean that the SBA will automatically challenge the economic necessity. It simply means that the SBA is saying we have the right to come back in and look at these loans to see if there is economic necessity. So there are some other changes that we've talked about, and the only one I'll hit on this slide is the one about individual taxpayer ID numbers now being able to be used. So for borrowers who have green cards or visas, that's outlined in a new FAQ. So FAQ 64. Not only did we get 4 new forms yesterday and an IFR, we also got several new FAQs. So there's the first one for you.
And hopefully these are things that are going to help resolve some of those error codes, people that were getting stuck.
Yeah. So if we move on to some of the other topics that are covered in the FAQs that came out, there's a revision. We've had conversations on these town halls about what number of employees to use on the loan application. And there was quite some confusion around that. So they actually did give us some clarity around that in FAQ 14. We've got a hyperlink there, and it basically says that an applicant with employees can use their average employment numbers over the same period that were used to calculate payroll costs, so either 2019 or 2020, or average number over the 12 months prior to the application. So that's one answer that we can check. We've got that number now.
That's great. That's great.
So I'm going to hit these super fast, and I've only given you the briefest of answers because the details are in the FAQs. So how to define lobbying activities. They give us a description. Can you use your first or second draw for lobbying activities? No. So nice, short and sweet answer there, but there's more detail in the FAQs. If a borrower was eligible for a first draw and then filed for forgiveness after getting that first draw, are they still eligible for forgiveness? And the answer is yes. But can they then go file for a second draw? No. And again, you'll find the more details in the FAQs. All right, so now we get a little more wordy because we're talking about some of the topics that we've also discussed on our town halls about second draw eligibility. So this one tries to clarify the conversations that we've had. Basically, to be eligible for a second draw, the borrower has to say that they have used all of the first draw, including any loan increases, by the time they receive the second draw on eligible expenses. And then the SBA gives us a little warning about, hey, don't forget, you got to calculate that 60-40 split. You got to look at FTE reductions and salary reductions. But they do say, they're not saying you have to meet the 60-40. They're simply saying you're certifying that you've used the funds for eligible expenses.
And Lisa, one other point, because this question comes in, if you did a first draw application with this phase of PPP, so starting mid-January on, you got a first draw, a lot of people want to go for a second draw. Right now, that hits an error code with the SBA. You cannot apply for a second draw yet. This is another reason why an extension would be good. But right now, it is impossible to do a second draw if your first draw was done starting with this phase.
Thanks, Eric. What if a borrower didn't get full forgiveness on their first draw? Are they still eligible? And the answer is yes, as long, again, as they certify that they've used the funds for eligible expenses. So this one is fairly nuanced for larger borrowers, and it's about using the SBA size standards. So if that is a situation that applies to you, you'll see that they've addressed it in the new FAQ that came out yesterday. Then we've got ERC, our favorite topic. Lots of complexity here, but we've got Chris Esposito who's going to dig into that. So again, just letting you know there's an FAQ here. For you eagle-eyed folks who said, where's FAQ 64? Just as a reminder, that is about the ability for using ITIN numbers. All right, so we do still have a couple of open questions, and one of them continues to be around whether or not other COVID-related grant programs are included in gross receipts for calculating revenue decline for second draw. I'm still advocating for an answer on that, and we will tweet it out, post it on LinkedIn, send out a special alert as soon as we can get any guidance on that one. We're also getting lots of questions about tax issues. So if we go to the next page, I wanted to point out a new resource, and this is for our AICPA members. It's courtesy of the tax section, but they've opened it up to AICPA as a whole. And April Walker, who I mentioned last week, did an ERC recording, is digging in with Chris Hesse, who's one of our key volunteers, around some of these really complicated topics around basis and when to record and how to record on the tax returns. So check that new recording out. And
with that, we're going to bring Kristen up here. So we're doing all right in time, but this is going to be the top of the waves ERC update.
Yeah, I will go a little quicker. So we're going to talk about the employee retention credit, and we're going to focus on the interaction between the wages that can be used for the credit and the wages that can be used for PPP loan forgiveness, because that gets a little tricky. Just quickly by way of background, the credit, it's a refundable payroll tax credit, and it's available to employers. It's in an effort to keep employees on payroll during the pandemic. And the CARES Act created it along with the PPP loans. And then the Taxpayer Certainty and Disaster Relief Act of 2020 that was signed into law in December actually enhanced and extended the credit. And the biggest change made by that law was to allow PPP loan borrowers to retroactively claim the credit for any qualified wages that were paid between March 13th and December 31st of 2020. Now, there is a catch, and the catch is that employers can't use the same wages for the credit and PPP loan forgiveness. So that does get a little tricky, but we're going to walk through some of that in a minute. you can go to the next slide. Yeah, we're bringing you actually the very latest on the credit, because on Monday, the IRS issued a notice. It was Notice 2021-20, and that provided some additional rules on the credit. And then just yesterday, Lisa and I had a call with the IRS and Treasury on some of our pain points. So we were able to convey some of those and get a few more answers on those. Now, since late last spring, the IRS did have close to 100 FAQs on their website, which did explain which employers are eligible for the credit, how to calculate it, and how to file for it. And while we were very appreciative of those FAQs because they were a quick way for the IRS to push guidance out, FAQs are not authoritative, meaning they can't be relied on for tax purposes. And a notice is authoritative. And we had been asking the IRS, we put it in a letter, and we had asked them previously, please issue authoritative guidance on this credit, because credits are complex and there's a lot of dollars at stake for employers. So we wanted to give them something to really rely on. So we were very appreciative when this notice came out. Now let's just quickly go through what is in the notice. Well, it gives us rules for wages paid in 2020 that qualify for the credit, and rules on the interplay between wages that qualify for the credit and wages reported on PPP loan forgiveness applications, which we didn't have that piece before, even in the FAQs, and we had asked for that. And there are some examples in the next few slides that will go into more detail. You can go back, sorry, yeah. We'll just going to hit some more of these items before we go to the examples. So what are we still waiting for? And I'm just going to go over some of the big ticket items. We're waiting for rules for wages paid in 2021, because that law that I mentioned, it actually extended the credit to June 30th of 2021. So now we need some rules on 2021, and they are a little different than 2020. And I know IRS and Treasury is working on those right now. They're going to get them out as quickly as they can. We also need to know if wages paid to an S corporation shareholder and their spouse are considered qualified wages for the credit. And this one has been going back and forth, back and forth. It's the number one question I keep getting from members since the law changed, and firms are really split on the answer. Did talk to the IRS about it. They know it's an issue, and they are trying to work this out. Part of the reason for the problem, there's a misplaced comma in the law, and we always need to have good grammar, or this is the kind of problems it can create. Also, another outstanding item is whether loan forgiveness proceeds are includable in gross receipts, in the calculation of gross receipts for the credit. Again, brought it up with the IRS and Treasury. They're aware of the issue, and they are looking into it. So we did reiterate the importance of answering these questions and other questions on that call. And so we do expect some further guidance to be released. And I would think it would be sooner rather than later. So I want to just point out a couple of other items that we get a lot of questions on that we have answers for. And that is one that relates to whether employer size for the purposes of the credit is based on full-time employees or full-time equivalents. And the answer is full-time employees. Again, another question that I get a lot from members. It is confusing because the law makes reference to the rules of the Affordable Care Act, which use full-time equivalent employees. But if you dig down further, the reference to it for this credit is to full-time employees. Let's go to this example. We're going to go walk through a couple of examples from the notice we just got to it walks through the interplay of the qualified wages for purposes of the credit and wages reported on PPP loan forgiveness applications that were already filed. And this is something we wrote a letter on in January saying that, hey, we really need some guidance, and the IRS came back with these seven examples, and we're going to go through a couple. So employers that already filed a loan forgiveness application might be thinking, well, do I have enough wages left over to claim the credit? And in most cases, I believe the answer is going to be yes, because in 2020, an employer can only claim up to $10,000 of wages per employee for the credit. Now that goes up in 2021, but we can manage that for 2021. But there are employers that filed an application for loan forgiveness and reported wages in excess of the amount they need for forgiveness because they really wanted to show that, hey, I have more than enough of wages to get my loan forgiven. And they really couldn't have known at the time they filed this application that they might need to hold back some of those wages for the credit. And now they're left wondering, well, can I claim the credit for any of those excess wages reported on the forgiveness application versus the wages that they may have actually needed to report? And the answer should be yes. And we advocated for that answer in a letter that we submitted to the IRS and Treasury in January. And the IRS responded to us in this notice, but their answer was, it depends. And they did go through 7 examples. So quickly.
Wait, one thing, Lisa, you're talking to a lot of firms. And I think another example, we'll probably just leave for the webinar attendees to look at. But Lisa, just maybe you want to summarize kind of, because you're having so many discussions, the interplay between ERC and PPP to help. So we have these other examples here. So the people can look at you can look at these other examples and maybe just close out here talking about the resources.
Yeah, really quickly, just refer to that notice if you haven't, because it gives 7 different examples, as Chris mentioned. And so it's going to walk through some of the options that borrowers are going to have if they've already applied. If you've already applied and one of these circumstances gets you, it's okay, because it might be okay because you've got other blocks of periods of wages to look at as well. So not all hope is lost on being able to take advantage of ERC. We've got some great resources for you that you can read in, and we'll get Chris back in, and I know we're going to do a deeper dive on ERC as well on a future town hall.
Well, thanks, Chris, and a lot of good information there. So now we can bring Barry and Mark back up. Pretty much, we'll be wishing everybody well here, but just a couple of more data points. Twice a week, we do have webinars where we go into deep dive about what's happening with our lending portal, but we talk about these error codes, and it could be helpful for you even if you're working with other lenders. So what we're hearing out there, Barry, is there's questions coming in about there's a lot. There's so much work with the tax work, with this PPP work, and I just want one thing that you and I have been talking about is we understand that, and I think you need to understand what do you want to do, and there is even questions coming in on your suggestion. Review all the Schedule C filers. We're going to try to work on some referral networks and things like that, because this doesn't mean that you should do all the work if you identify it, and we're going to work on kind of giving options. But maybe you want to kind of comment just on that workload kind of compression feedback that we've gotten with some of the questions here.
Yeah, there might well be some firms that choose not to or don't have the capacity, but they want their clients to be able to benefit from this. And part of that trusted advisor role can be doing the connection, and we're looking at ways to try to help that. I think that's an important aspect. And going back to stuff that we started to say back in 2019, 2020, I'm sorry, you have to rely on the technology too, and not try to do all these calculations yourself. There's we have tools. There are other tools in the marketplace. And I think really understanding the frustration that the lending community is having and what we have available to firms to help you through that process, as Eric has described, I think that's an important part of it too. For new things that are not with existing banks and existing outcomes, instead of focusing on how that might get bogged down, there may be other ways that can be a little bit more efficient in the system.
Well, Barry, maybe with the lightning round here, and Lisa, I think you and I both seen this question, just the ERC, your position on kind of our position on the ERC guidance that came up from the IRS this week.
Well, we certainly think that borrowers should not have been penalized for doing what they were asked to do, which was lenders were saying, yes, you can just use payroll. Give us the reports. That's easy. That's something that we can rely on. Let's drive on. And now they're being penalized, which was. And
the same thing applies to the Schedule C issue,
right,
where the cutoff date, there's already a lot of political pressure to say that's an inequity in the system, that those Schedule Cs that were filed before, not eligible to take the gross approach, there's going to be some real pressure to change that.
So thanks, everyone. Let's just bring up the final couple slides here, talk about where we're headed. A lot of good resources here. We skipped past a couple of our resource slides. You got the archive of the past town halls. Here's the AICPA PPP Resource Center. There's the PPP Resource Center on the CPA.com site as well. More detailed information related to kind of lender activity, and then that tax treatment chart that is a new resource available. We're staying active on LinkedIn and social media, and we will have our next town hall on March 18th. So stay connected with us via our many different communication pieces. We know, again, Barry's opening today. There's a lot going on. It's a stressful time. We're here to support you. Don't hesitate to reach out to us. Thanks for this hour. We greatly appreciate it.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.